I'm going to talk about why I think it's going to be a big year for gold in 2024. In fact, I think this is going to be the first in several big years for gold. And it's not often I say that. I talk about gold a lot, but I'm pretty measured in talking about the future, because for me it's just something to own periodically. And I'm going to talk today about why gold serves as an early warning system and try and decipher what it's been telling us in the last couple of years. And I want to begin with this. This machine on the right is Dr. George Merriweather's leech-powered Tempest prognosticator, which he displayed at the Great Exhibition in London in 1851. Now, those jars down the bottom, each one of those had a leech, a live leech in it, and each leech had a small chain tied to it, and the chains ran up there through the top there, as you can see, to small bells, because Dr. Merriweather found out that when barometric pressure changes, leeches get agitated, so they'd start wriggling and the bells would go off. Simple, but effective. Now, our friend Mr. Merriweather read a 3-hour essay about this machine. The title of it was The Essay Explanatory of the Tempest Prognosticator in the Building of the Great Exhibition for the Works of Industry of All Nations. A snappy title. I trust you'll agree. And he spoke for this about 3 hours. Now, you're all sitting there thinking, what the hell is this idiot talking about? And why the hell am I not in room 4 listening to somebody else? It's okay, you can say it out loud. Leeches back in the 1850s were found to be an early warning system for approaching storms. And my belief is, and always has been, that gold performs exactly the same function in the financial system. Now, to me, avoiding drawdowns in your portfolio is absolutely the most crucial thing for any investor to do. If you can step aside when the storm comes, it's going to really improve your returns, and gold is going to help you do that. As I said, I've got 37 charts to get through, so let's get into them. Now, prior to 1971, the price of gold, as I'm sure you'll all know, was fixed. And it was fixed for much of the preceding 200 years, including through the Civil War here. Now, this chart isn't exactly the most exciting one I've ever put together, but you can see on the right side of that chart, you can see the pressure building in a fixed price asset as we went through this series of panics. Those ups and downs on the right there shouldn't really have been happening. Now, that changed after World War I, when gold was pegged a little higher there on the left to relieve some of that pressure. But it was the Great Depression which really holds the key in how this all works. Now, gold, as you can see there, initially was liquidated as a series of margin calls kind of rippled through the entire financial markets, but it quickly recovered back to its peg, and then it got confiscated under Executive Order 6102, which I'm sure most of you have heard about. And after that, as you can see there, the price of gold is revalued much, much higher. But that V, gold is supposed to go up during crises. How did it go down? A, during a crisis, and B, more importantly, if the price was fixed, how the hell did gold go down? Well, that is deflation at work, folks. So I want to take a look at what really happened here. At that time, the Dow Jones, at its peak in 1929, was deemed unstoppable. Those are the headlines. You will probably heard of this famous expression that the Dow Jones had reached what Roger Babson called a permanently high plateau, i.e. stocks were never going to go down again. And as soon as he said that, they crashed. The Dow fell 85% from peak to trough. But I want to look at this in terms other than price, because I think price, at the best of times, can be deceptive. And I want to make a distinction here between price and value. Price is what you pay for something. Value is what it's actually worth. And it's a really important distinction to make. You can see here that gold, in price terms, though it was pegged, still fell there to $17.06 as investors were desperate for liquidity. But if we look at gold in terms of its purchasing power through this period, things look very different. On the right here, you can see these are units of the Dow Jones that you could buy with 1 ounce of gold. It started off there at 0, but a year later, you could buy 2.4 times as many shares of the Dow as you could at the beginning. Even at its trough there, you can see when gold had fallen $3, you could still buy 4 times as many units of the Dow as you could at the beginning. So even though the price went down, the purchasing power of gold went up. By the end of it, when gold returned to its peg, your purchasing power had increased 7-fold. And that's what gold does in times of crisis. It's not about the price, something that a lot of people forget. Now, Executive Order 6102 was another one of these early warning systems that gold was trying to tell us about. Immediately afterwards, they revalued gold higher, although technically what they actually did was devalue the dollar by about 60%. That devaluation meant that less gold was needed to support the amount of US currency in circulation, and that allowed the Fed the flexibility to increase the production of paper money. Now, within 5 years, as you can see there, World War II had begun, and the US soaked up another 12,000 tons of gold, which it exchanged for arms and munitions under the Lend-Lease Act. Gold was once again sending signals to us. The US at that time was by far the strongest country in the world, and so that is where the gold headed. Now, after World War II, even though the US actually ran small trade surpluses, gold, physical gold, started to flow out of the US before the trade balance began to deteriorate. By 1966, foreign central banks owned more gold than the United States did. The price was fixed, though, so physical gold could actually move from country to country without setting off any alarm bells via the price, at least outside the Beltway in Washington, which is exactly why in 1971 Nixon closed the gold window. They could see the gold moving, but it wasn't reflected in the price. By midway through 1971, it was clear that the entire financial system was following gold's lead. And this brings us to that fateful year, 1971. By 1971, US money supply had increased by 10%, and things had started to shift. In May of that year, Germany effectively resigned from the Bretton Woods system. They were unwilling to exchange Deutschmarks for dollars at the fixed exchange rate. And unfortunately for everybody concerned except the Germans, the country's economy improved dramatically in the next 3 months. The Deutschmark actually strengthened by 7.5%. And once that happened, a lot of other countries tied to the Bretton Woods started to have second thoughts. The Swiss redeemed another 50 million US dollars in May. The French, who'd started this whole bull rolling with de Gaulle's famous exorbitant privilege speech in 1965, they redeemed another $191 million. And on August the 9th, the Swiss officially left the Bretton Woods system. 6 days later, everybody in America watching Bonanza had their evening ruined when the show got interrupted by Nixon, who came on to warn of evil speculators and sever the connection between gold and the US dollar. Now, once that peg was removed, gold was finally free to express those warnings it had been trying to sound in the days leading up to the closing of the gold window. You can see this first window here. That's the pressure that had been building up on gold, finally being allowed to release when it was allowed to trade freely. The second wave was gold warning about increasing inflationary pressure and the damage that that was going to do to the purchasing power of the US dollar. Now, once Volcker broke the back of inflation, gold's role as a vital part of any portfolio designed to protect purchasing power was greatly diminished. And guess what? The price, once again, reflected that. It fell very, very quickly. And the last 2 decades of the 20th century were actually a really good time to not own any gold. You didn't really need it. There weren't too many storm clouds on the horizon. Now, if you look at the Dow versus gold between 1980 and 1985, this shows you exactly. Gold is telling you here there's nothing to fear. 1980, once inflation had been broken, you can see how quickly gold fell, 40-odd%. You didn't need it. You didn't need it as a portfolio diversifier. You didn't need it as a hedge against market or geopolitical uncertainty, and you didn't need it as a source of liquidity. The leeches, if you like, were asleep in the jars. Gold began to fall exactly as equities were declared dead by this very famous Business Week cover. And we all know what happened after that. Equities went on the bull market of a lifetime. What some people who were listening to what gold was saying were central banks. And once they got inflation under control, as you can see here, they slowly but steadily began reducing their exposure to gold. They felt they didn't need it to hold it so much, and they were doing that at a pretty steady pace until about 1989, when something very important happened. The Berlin Wall was taken down. And boom. Once communism gone, who needs gold? Communism's dead. The enemy has been conquered. The West has won. It's a new era of safety, a new era of prosperity, and you really don't need something like gold. And central banks, believing this, began essentially throwing their gold out the window at everybody passing by in the street. The Canadians, the Brits particularly, got rid of all their gold, which is looking now like an incredibly foolish thing to do. But they did it with good reason. Now, this chart shows just how stable the world was quickly becoming after a quarter of a century there from the left of the chart to that peak, which is around when the wall came down. We had a quarter of a century of the world becoming steadily more politically stable. And once the wall came down, the need to own gold just went away with all this political instability. The Nasdaq, as I'm sure you remember, screamed higher against this kind of backdrop of newfound tranquility. And you can see that gold was telling you didn't need to own it. There was nothing that gold could do for you that you needed protection against. It was understandably left behind, falling against that performance in the Nasdaq. Now, as an early warning system, throughout the 90s, gold was saying everything's safe. You can see here, this is the price during the 90s. It just gradually drifted lower. And particularly as the decade drew to a close, there really wasn't any bad weather approaching. Now, this whole dynamic was reinforced, of course, by our friends at the central banks, who slashed rates in the wake of the wall coming down. They did a pretty good job, you've got to give it to them, in getting rates back up to a more normal 5-6% level during the middle of the decade. And then we had the Nasdaq bubble. Then we had the Nasdaq bubble burst. The economy was humming along just fine, but the Nasdaq bubble burst. And even though everything was looking okay, you couldn't really tell by looking exactly what was happening under the surface, but gold was already starting to warn us that there was trouble ahead. The global economy had been growing pretty steadily, and a couple of years later, China's entry into the WTO was going to give it another shot in the arm. And on the surface, it made it look as though, if you looked at economies, you looked at stock markets, you didn't need to own any gold. But if you were paying attention to gold, it was actually, once again, ringing the bells and saying something completely different. The leeches were getting agitated. As the Nasdaq bubble burst and as Greenspan slashed rates, gold finally, as you can see here, began to stir. And it bottomed in around 2000, right when the bubble burst. And it began what would so far be a 2 decades long climb as the financial and economic conditions measured by anything other than asset prices deteriorated. Under the surface, the deterioration was growing. Post-dot-com central bank monetary policy made it very clear to gold, at least, and anybody following gold, that the Fed was now in the debt monetization game, and that the debasement of the US dollar and just about every fiat currency around the world was the ultimate end game. Now, if you look here, gold actually spiked in 2006. Now, think back to 2006. I mean, talk about the best of times. That was it, right? Markets were peaking. The housing market was on fire. Everyone was thinking this was going to go on forever. 2006 was a really, really good year, the very top of everything, and yet gold spiked. Why? You know, as the effects of easy money made themselves evident, the housing market finally, gold jumped again at the end there, and it peaked in 2008 when Bear Stearns surprised so many people by going to the wall. But it didn't surprise gold. Gold had already sniffed that out in advance, as you can see here. What did surprise a lot of people was the fact that in the immediate aftermath of Bear Stearns falling, gold actually fell. That surprised a lot of people. And once again, you had this narrative around gold's supposed to go up. We're in a crisis. Why isn't gold going up? This is the same as we had in the Great Depression. It's the liquidity thing. It's the purchasing power thing. Same thing happened. You could buy almost 3 times as many units of the S&P 500 as you could before gold fell 30% in the wake of Bear Stearns collapse. But despite gold's fall, in the wake of that Bear Stearns collapse, this simple fact remains. Since 2000, when gold bottomed and started sniffing out trouble ahead, it's been signaling that there's approaching bad weather. And it's outperformed the S&P and the Dow for the last 23 years handily. And that grey line in the middle there, that's the S&P total return basis. So even if you reinvested your dividends, gold has still outperformed significantly. And think of all the stress you'd have removed from yourself by just owning gold in the bank account and not watching the Magnificent Seven and not watching the 2008 crisis and not watching all the sturm and drang that we find in financial markets. Gold does the job for you. Now, you won't be able to read the bottom line here. If you haven't seen Ronnie Sturfeler's presentation, Showdown, I would recommend you either watch it. I'm not sure if he's spoken yet. If he hasn't, go see it. If he has, find it on video and watch it. But this chart shows you that gold's CAGR in every major currency in the world since 2000, it's risen 9.6% per year in dollars. It's double digits in the yen and the pound, and in Indian rupees, it's 12.5%. But the average is about 9% CAGR in every currency on the planet. And all this while things were supposed to be rosy, while everything's at all-time highs and asset prices are going through the roof. Now, the next barometric pressure change, obviously, we all remember this one, it came with COVID. And again, while gold was initially sold to raise cash, people got margin called when markets fell, it very quickly bounced, telling you that the storm wasn't over. Even though trillions of dollars of stimulus were thrown at the world, gold was telling you the trouble's not over yet, even though markets went higher. In fact, since March of 2020 versus what is the traditional safe haven of the bond market, gold has again been not only warning of inclement weather, but preserving and enhancing anybody who owns its purchasing power significantly. Up 37% from March 2020 to last December versus a 31% decline in long-dated treasuries is no mean feat for an inert rock. All of this leads us to today and gold's strong end to 2023 and its strong start to 2024, what is it trying to tell us about not just the year to come, but the years to come? And I suspect the answer to that is quite a lot. Firstly, gold's relationship with real interest rates is historically a troubled one. You can see here on the left of the chart, when interest rates are stable, gold tends to trend sideways. When real rates go up, gold, quite understandably, goes down, but not this time. And that begs the big question as to why. What kind of bad weather lies over the horizon? What kind of bad weather is gold trying to warn us about? The beauty of it is it doesn't matter what kind of weather we're in for. All that matters is that we are prepared for trouble. And gold is, again, ringing those alarm bells for us and telling us that the future is not as safe as perhaps people would like you to believe it is. For the last 2 years, central banks have been buying gold at a greater clip than any time since decent records began over 70 years ago. Now, traditionally, central bank gold holdings hovered at around 40% of their reserves. That's now closer to 20%, thanks to the dilution of their balance sheets by rampant bond buying and decades of stimulus. What's more is that buying is coming from outside the G7 nations, which suggests that the dollar, at the margin at least, is no longer the reserve asset, as we discussed on our panel yesterday morning, for any of you that caught that. In fact, the BRICS and the Shanghai Cooperation Organization together just overtook the US in terms of the number of ounces of gold they own for the first time. And if you look at that red line, you'll see the trajectory is getting steeper. This is a very deliberate and accelerating pattern. It didn't just happen coincidentally. Post-COVID, the massive stimulus has changed the barometric pressure in the financial system. And despite all these trillions in stimulus and record highs in stock markets and asset prices around the world, gold has been knocking on the door of all-time highs in dollars again and again and again, having made all-time highs in multiple other major currencies many, many times over in the last 10 years or so. What's more, I'm sure many of you have seen this chart before, but it's an important one. This is a very multi-year cup and handle chart from which gold has finally broken out, and that portends much higher prices further ahead if you are a technician. The buyers of gold among the central bank community are incredibly sticky. They're not buying it for a trade like a lot of people do. They're buying it, as we spoke about yesterday, to diversify away from the dollars and secure their national interests via their reserves. The BRICS and BRICS Plus countries are aggressive buyers, as you can see here, and the West countries just sit pretty idly by so far. I suspect that's going to change. They'll be forced to change, but for the time being, Western central banks don't seem to have any interest in gold. Unlike printed money, increasing supply of gold to meet demand or to lower prices is just not an option. If you look at this chart here, it shows you that reserves in the ground among the top 10 mining companies in the world have fallen 33% since peaking in 2010, and that's not going to change anytime soon. But if we look at gold mining stocks, as I know many of you do, they've stubbornly refused to follow gold's lead over the last 2 years. You can just feel the frustration when you walk around the floor here. But if you step a little further back, you can see that the miners, as they tend to do, just got ahead of themselves in 2020 and have been settling down ever since. Gold's 30% rise off the pandemic lows triggered a 110% rise in the major mining stocks and 150% rise in the juniors. That's what mining stocks will do. And once gold's warnings get taken seriously by more people, as I firmly believe they will be in the coming year, the alarm bells you're going to hear will be deafening. And that's going to mean a big year for gold and an even bigger year for the gold and silver mining stocks. Now, I recently spent some time with John Hathaway, one of the doyens of the gold market, a man who's forgotten more about investing in mining companies than just about anybody in this room, Rick Rule notwithstanding, as we'll ever know. And he shared 4 things with me which I want to leave you with today. Firstly, this point he made is a really important one. Gold is trading at record highs in nominal US dollars, despite the fact that gold is flowing out of ETFs. That's Western investors selling. It's not Eastern investors. And if you compare that to the years following the global financial crisis, we saw the AUM of the gold ETFs approximately double. Second point John made was this: the average gold price is up 20 to 25% over the past 10 years, while the average stock price is down 40%. These stocks are unloved and massively undervalued. Even if gold catches half a decent bid here, these stocks are undervalued and underowned. Thirdly, investment by the gold mining industry in new reserves, and this is another really important thing to understand, has actually yielded negative results. We've had a contraction in reserves despite additional money spent on trying to locate them. And finally, this one: And I think this is perhaps the most important. The allocation to gold right now is about 1% of global AUM, compared to its peak in the 80s. The last time we had an environment like this, with inflation being a threat, it was 8%. And as John said, tongue-in-cheek, it's fun to speculate on the events that would lead today's allocation from 1% to just 2% or more. So if you take away two things from this 20 minutes and a few more seconds, because I've gone over, it's this. First of all, please try not to obsess over the price of gold. Focus on the value of gold and focus on the signals that it's sending and its purchasing power against other assets you might want to own. At some point, you might not want the gold, but think of exchanging it for something rather than selling it at a given price. At the very worst, it'll help you stand still if those assets continue to rise, but in an increasingly dangerous world like this one, it will improve your purchasing power dramatically. And secondly, try not to think in terms of buying gold or buying mining shares. Think about ownership. Think about owning gold and think about owning shares in good mining companies. Because when you're an owner, you think differently. If you've bought gold, it tends to imply that there's a sale point, it's a trade, you're really focused on the price. Be an owner. Own gold for its protection, for its purchasing power protection, and own mining shares for the stream of income and the capital appreciation they'll give you. That's it. I've run over time. I don't have time for any questions, but I will happily chat with anyone that wants to ask me anything. Thank you.